Thank you for joining this Yellowstone Advisory webinar. Today's company presenting is International Airlines Group, and we're delighted to have with us today Stuart Morgan, the Head of Investor Relations. I'm now going to hand over to Stuart to start today's presentation.
Thanks very much, Alex. I'm just going to take you through a summary of our Capital Markets Day CEO slides. You can actually find the presentations, all of the presentations, and a recording of the CMD on our website. And I'll also briefly comment at the beginning about trading. So just to set the scene, IAG is a market-leading group based in the world of commercial aviation. We're focused on large, attractive, and growing markets. We have some very powerful brands within those markets. We generate leading margins and returns, and we've got a track record of generating sustainable shareholder returns, at least until COVID hit us. So, our strategy is fairly simple. It's to strengthen our core business. It's to drive earnings growth through some asset-light businesses. These are an increasing focus of the business. And it's also to make sure we have a strong financial and sustainable framework to make sure this business will continue to be successful into the longer term. Briefly focusing on each of those, growing our leadership positions, as I said, is about our core markets. It's about growing in those markets. It's about focusing on our Spanish businesses, the world-class brands and attractive markets. Each of our brands, aviation brands in particular, are very strong in their local markets and their local hubs. And then loyalty is a wrapper that brings those together, but is also becoming a very powerful generator of profit and cash in its own right. So as I said, our objectives are to maximize total shareholder returns, margins and returns, disciplined balance sheet, sustainable dividends, and the ability to generate further returns if available. I think what the last 12 months has told you is that this is a very resilient business. Our Capital Markets Day in 2019 focused quite a lot on the resilience and sustainability of IAG and its airlines. If you just look at this year, we're already back to pre-COVID margins, pre-COVID returns. Our balance sheet leverage is at the same level as it was at the end of 2019. And we have recently committed to returns to shareholders when we think the moment is right. If you look at what's happened this year, we've seen very strong customer demand across all of our markets. And this has been helped by a certain degree of constrained supply as airlines get back up and running, and the amount of both people and fleet has been hard to come by. In addition, our cost control has been good. Unlike most other airlines, we've seen improvements in our unit costs during the year, and our cash flow as a result has been very good, and we've taken that opportunity to strengthen the balance sheet, not just through net debt, but also in reducing our gross debt. So as we exit the year, we feel as though we're in very good shape. In terms of our near-term strategic priorities, as we look to the next 3 to 4 years, this is mainly focused in 4 areas. What we call transformation is making sure that every day, everywhere around the business, that includes all of our operating companies, we are looking to do things better. It's not a case of sort of grinding out a bit of this and a bit of that. We want to create a step change in opportunities in all of our businesses. Secondly, we want to leverage the good position that our Spanish businesses find themselves in after a significant amount of transformation in the last 10 years. These are businesses that we think can generate over 1.5 billion euros of operating profit, which in itself will bring more diversity and more resilience to IAG's overall portfolio. Thirdly, it's about investing in British Airways. BA has been left behind somewhat by its sister airlines during the year. It's partly because of the constraints of the environment we operate in, but it's also because we need to continue to invest in that business to drive better customer satisfaction. We think there are margin and profit opportunities to come there. And then, as I said, growing IAG loyalty. Loyalty used to be something that was just helping to support the revenues of our various airlines. It still does, but in its own right, it's an seasonal, so therefore helps the cyclicality of the business through the year, highly cash generative business. And then that's all underpinned by the usual capital discipline that IAG has always had, and as I said, an increasingly strong balance sheet. Moving on to the structure of the group, IAG as a corporate parent focuses on three main areas. Firstly is the overall portfolio management, financial strategy, allocating capital, driving M&A, reviewing the portfolio on a regular basis to make sure it's the right one for the group. Secondly, performance management, and that is very much focused on the operating companies and ensuring that they are driving or maximizing returns and margins. And then finally, and this is probably a more developing part of our structure, it's the real ability to drive best practice and sharing of experiences. Our management team have all worked in other businesses within IAG before, and it's that increasing synergy we drive from that we think is going to be a future benefit of the group. The operating companies themselves, mainly the airlines, but also our non-flying operating companies, which are the loyalty, cargo, and maintenance businesses, they all have their commercial independence. They're responsible for their own P&Ls every year, and also for driving their customer strategies. And then finally, IAG has a sort of a group of common platforms and functions which sit best outside of the operating companies, such as corporate affairs, investor relations, transformation, procurement, and group finance. IAG's got a strong track record of leading performance. You can see on this next slide that all of the airlines have improved substantially since IAG's inception. BA Iberia in particular being the poster child for that particular process. And then looking at this year, we continue to outperform our peers. And here we focus on our peers being mainly the network carriers based in Europe and North America. Just stepping back a little bit, looking at sort of the market trends, aviation and travel, we think is a secular long-term growth business. Apart from the 2 years of COVID when we were shut down, we have always seen growing demand in this business, and that's despite the fact that we've had various sort of perceived shocks through the years. Those shocks tend to be short-lived in nature, and people continue to want to travel more and more despite those. And then on the right-hand side, just looking forwards, we think travel is a priority and an increasing priority for most people. We see there being a shift to travel as an experience. And we also think travel is a higher priority for most customers, perhaps over previous focuses on hard products or even your day-to-day consumables. Importantly, we're also seeing a supply constraint at the moment. One of the factors of COVID has been that the supply in both Airbus and Boeing aircraft deliveries has been substantially slower than expected. This also affects other parts of the supply chain. So you'll see that parts, engineering, maintenance are all constrained. So what you have is an industry where people have often grown and produced too much supply. Their ability to do this, we think, for at least the medium term, is substantially constrained. Moving on to our markets, we operate in some of the world's largest and most attractive markets, and 85% of our passenger traffic, the seats that we fly, is in the most attractive markets of North America, Latin America, and Europe. Although we do have some capacity also into the more selective parts of the Middle East and Asia in particular. Our hubs are also some of Europe's largest hubs. Heathrow is obviously the largest in Europe, but Madrid itself is the 5th biggest. Barcelona is the 8th biggest. So our positions in those hubs with strong market shares in those hubs is part of what drives our margins and returns. And those hubs also give us access to the markets that have competitive advantage in those markets. Firstly, our home nations are large parts of the total markets across the Atlantic in particular. But also, if you look at geographically speaking, we sit Dublin, London, Madrid, all sit on the western edge of Europe, which if you're a consumer, a traveller, tends to be the best place for that transatlantic travel. A couple of weeks ago, we set out this framework for where we think about investing, and this is what drives our capital allocation process. So our core profit pools are where we have the biggest existing strength and where we make the most money, and therefore where we are going to prioritize and strengthen our positions. We cut it 3 ways: by region, by hub, and by business unit. And unsurprisingly, again, you'll see that this is about the US, it's about Latin America, and it's about domestic and short-haul travel to and from Spain. We also have some highly attractive near core profit pools where the size of the market is not necessarily as big, but they also are attractive for us. And then we also look at potential future profit pools where we can selectively grow, perhaps initially through partnerships, through our joint businesses and joint ventures, but also growing direct capacity over the years as we grow our fleet. And I'd probably call out India here as a good longer term opportunity. So just briefly focusing on our core markets. North America, we have just under 50% market share with our 4 airlines of BA, Iberia, Aer Lingus, and Level, which is our relatively new low-cost long-haul business. It's about investing in the network and its breadth and depth. So that's adding cities and it's adding frequencies and adding the competitiveness of our businesses in those markets, and therefore investing in the customer experience. For example, we fly 150 times every day across the Atlantic from our various hubs. Moving on to Latin America, as I said earlier, this is about creating a bit more balance in our portfolio, and we're targeting over $1.5 billion of profit from our various Spanish businesses. This is fundamentally based on Iberia's turnaround and that efficiency, and also the fact that some of the Latin American carriers have gone into Chapter 11 over COVID and are therefore smaller, makes us able to take market share and become very profitable in those markets. So again, we have slightly less market share of just over 30%, but we think we can grow very efficiently and successfully in these attractive markets. And what you also have is that Latin America to Spain, the growth in investment, in cultural links, and in population flows has become significantly stronger over the last 5 years. So it's an inherently bigger market than it used to be pre-COVID. And on your Air Europa, which is a business that we have stated earlier in the year that we want to acquire, it's still going through the EU approval process. But the rationale here is that Air Europa has a very attractive network, both domestically and transatlantic, and in particular in the Latin American market. Iberia itself doesn't have as big a position in its home hub of Madrid as some of the European players such as Lufthansa and Air France do, and therefore this is an opportunity for us to consolidate in the same way that our competitors have, and therefore we have access to more planes and a more sustainable business, we think, results for customers as much as us in the longer And then, as I again alluded to a little bit earlier, we want to grow through our businesses, as our joint businesses, as much as anything else. Qatar is the biggest one of those, which gives us more opportunity flying east. BA is the only one of our airlines that does any substantial flying east of Europe. They will continue to serve their own selected markets, but we have access to a huge range of other places through these various joint businesses. Over the years, we've grown through the IAG structure. I think the point of the slide here is to show that we either organically or inorganically, directly or indirectly, have become a stronger, better business over the years. As I just mentioned on the right-hand side of this slide, we said we want to acquire Air Europa. We would look at other airlines if there's an attractive market opportunity there. And then also Level has just announced it's opening its own AOC. And AOC gives you a little bit more commercial and operational independence, and also gives you the opportunity to use a different cost base and different customer proposition to make sure that they're appropriate for those various markets. Just briefly on our brands, as I said earlier, again, these all nicely fit into the markets that they are targeting. BA and Iberia are both premium brands and fit nicely into the bigger, stronger markets out of London and Madrid, respectively. Aer Lingus has a very attractive transatlantic proposition as a value carrier, but also as a nice, small, premium leisure traveller. At the other end of the scale, Vueling is a very competitive European short-haul business. As I say, Level has just set itself up and has some interesting opportunities as a low-cost, long-haul business. We've recognised the need to invest in British Airways. BA has 5 main pillars of its strategy: to continue to invest in its London leadership, and that's mostly in Heathrow, but also in Gatwick and at London City. It's to invest in its premium proposition in those markets. It's to invest in those people who deliver our services and operations day in, day out. It's to be better at that. So our execution needs to be better and more efficient. And it's to make sure that that is all sustainable in the longer term. So the key areas of focus are basically in our customers and our IT, and also in managing the operations. I think most people here would recognise that BA's IT needs substantial overhaul. That is not an easy process. It's not a short process. We're about halfway through that. We're currently fixing the fundamentals of the IT, so moving into the cloud, focusing on improving the data centres, and then the more customer-focused and revenue-focused parts of that will be delivered over the next couple of years. The other main area is focusing on the management of operations. Again, Heathrow is a difficult place to work out of, but we still have responsibility for a lot of the delays, and we want to reduce that substantially going forwards. As we do that, as we get further aircraft deliveries, so again, an important point to mention here is that BA retired its 747s in 2020 and 2021. That left a big deficit in long-haul aircraft. It left a big deficit in premium aircraft, premium seats. And as we restore its long-haul capability, that will also help to drive margins in that business. Just quickly moving on to loyalty. Loyalty has 2 main aspects to it. As I mentioned earlier, it helps to drive customer loyalty in the airlines. Those airlines benefit from the revenue. We're also trying to make it more attractive by broadening the ability to spend those Avios points that you earn on a wider range of things, but also a greater ability to spend them on the core airline offering, such as the Avios only points flights that we now have started to offer. The other side of it is starting to expand our non-airline value here. So we generate over €1 billion of revenue from our non-airline partners, in particular our financial services partners, and a lot of you will have, I hope, a BA branded Amex credit card. It's the Avios points that you earn, and therefore what you can spend those Avios on that generates the value here. This is a business that's doubled its growth in the last 5 years and continues to grow very quickly. It doesn't need the capital that the airlines obviously spend on their fleet and their product. So we think it's a highly attractive generator of free cash flow for the IAG group. Sustainability is important. As an airline, we're aware that we generate carbon emissions. We have a plan in place, a roadmap in place towards net zero by 2050. The first step in that is more fuel efficiency, mainly through our newer generation aircraft. We've also targeted using 10% of our fuel being SAF, sustainable aviation fuel, by 2030. That will require more production of SAF, which is the bit we can't control, but what we can control, we're very focused on delivering, and in order to meet that commitment by 2030 and also by 2050. Briefly touching on our people, we're investing significantly in our people. We've hired a huge amount of people. I think it's 15,000 people over the last 18 months. It's now about making sure that they can deliver the best service to our customers. Partly that is driven by better training. We're giving them the digital tools to be able to do that better. We're also increasing mobility across the group. So as I mentioned earlier, it's both at the very top in our management committee, but it's increasingly through the business where we have the ability to move people around and therefore share best practice, and to share the ability to maximize both revenue and profit in each of the businesses. And then just finally, what that all leads to, so again, as a reminder, growing our global leadership positions, strengthening our portfolio of brands, improving our customer proposition, improving the efficiency of our operations, and growing our capital light, high cash conversion loyalty business turns into sustainable profitability. So we set out margins and returns that are more or less the same as pre-COVID. I think an important point to note here is that the near-term investment that I was talking about means that we will build through those towards and through those targets as we deliver those over the next few years. And then growth, we see 4 to 5% growth as the business normalizes, having replaced a lot of our fleet in the next or last year and this year, and a little bit next year. That normalizes into some attractive growth into those markets. And as I said earlier, just making sure that we have a strong balance sheet with gearing of less than 1.8 times. And what does that mean for us, and hopefully for you as shareholders? It's EPS growth, it's an ordinary dividend, which we would want to be sustainable, and a share buyback and or special dividends, or whatever the mechanism is, should the opportunity arise and should there not be any inorganic growth opportunities. And on that note, I will open to questions.
Brilliant, Stuart. Thank you very much for that presentation. It's good to be reminded that International Airlines Group isn't just British Airways, it's Iberia and Aer Lingus and Vueling and all the others as well. So look, we're now going to take questions, and just as a reminder, if you do want to ask a question, please type it into the Q&A box at the bottom of your screen. This is a good opportunity to put to Stuart any questions you have on the British Airways, the IAG strategy, etc. So let's start with the first question here. One of the targets set out in the Capital Markets Day was a commitment to dividends once the balance sheet and investment plans are secure. What does this mean, and what is the timescale?
I think it means what it says on the tin. I mean, I think if you look at the share price, one of the things that makes us look cheap is that people are nervous about going into whatever the scenario is on a macro basis next year. Is it a recession? Is it anemic growth? Whatever. I hope what I've sort of said today gives people confidence that the business is more resilient. But if nothing else, investors want this to be a business that has a very strong balance sheet, because bad things have happened in the past. So that is a huge priority for 2024 to make sure that balance sheet stays strong. And then also, the ability to spend the money that the business needs to have spent on it. It's a lot of it's BA, but it's not all BA. Means that those two remain the absolute priority for now. I would say that as we go through 2024, that situation should clarify somewhat. So that would give us an opportunity maybe to look at definitive timelines on that commitment. But we are very committed. I mean, the team is measured on total shareholder returns. We are committed to delivering dividends and further returns as soon as we possibly can.
Okay, thank you. And look, just a related question to that. Could you be a bit more specific about the shareholder returns?
Well, I think historically we paid, as I said, a regular dividend that would probably be based on a percentage of our earnings every year. So again, in a business that goes through the cycle, I think that is a more sensible dividend strategy, and is what most airlines would have. And then if you look at sort of potential free cash flow, assuming that we're not out there sort of buying any other airlines, then there's an opportunity, I think, for some fairly substantial returns through other mechanisms. Look, if the share price continues to stay very low, a buyback might be attractive. If it's not, then you might look at both either the ordinary or some sort of special divvy.
Okay, thank you. Can you go through the nature and quantum of the exceptional items this year and the likely nature and size of exceptional items next year?
That's quite an easy one. There are no exceptional items. So one of the benefits, if you look at our margin range, despite it perhaps being initially at the lower end of what we were doing pre-COVID, the fact that we don't have substantial restructuring costs and that we don't have pension repayments means that our cash conversion is now actually a lot higher than it was before COVID.
Okay, that sort of leads on quite nicely to the next question. What happens if there is another pandemic and everything gets shut down again?
I think the likelihood of that happening is very unlikely, but I think coming back to what I just said around the balance sheet, we would want to make sure we have as strong a balance sheet as possible, and that would give us the opportunity, I guess, to sit it out.
Okay. Next question here. Can you explain further how the loyalty business earns revenue?
Two ways. One, it sells, well, the main way is effectively is that it sells Avios points. So the airlines buy Avios off loyalty in the same way that American Express buys Avios off loyalty. Those are recognized in slightly different ways. So again, when American Express, for example, buys those, they're recognized immediately. When the airlines buy them, they get recognized when those points get used, and then minus a few costs of doing so. So again, there's a charge for seats from the airlines. They generate substantial profits and cash flows.
Okay, so just to sort of clarify, the separate loyalty business sells Avios points to both external customers like a credit card and an internal customer like the airline itself.
Yeah, so your revenue is the sale of the points. The costs you generate are generally what you are rewarding those points with. So that's mostly airline seats, but with a few other things joining that at the moment, less a few costs of operating the business.
Okay, thank you. Are there any other opportunities for further M&A to add to the airline brands in the group?
So, I mean, we were publicly interested in the disposal of TAP by the Portuguese government. The way that would fit into the group is that we operate a lot of capacity into the Spanish-speaking part of Latin America at the moment. We don't operate into the Brazilian market, and TAP has by far the biggest share of the Europe to Brazil flows. So, as I say, that would fit in very nicely. We have an alternative there insofar as we get an aircraft called the A321 extra long range XLR starts to be delivered at the end of 2024 over the next 24 months. That gives you organic direct opportunities to reach certainly the north coast of Brazil. So that process is on hold whilst the Portuguese government goes into transition. We're not in a particular hurry to do that. Our focus is on Air Europa. But we are always interested in consolidation opportunities if they're the right one that fit in that network framework we talked to and gives us sort of that market share and the margin opportunity and the value creation opportunity that we've historically secured.
Okay, thank you. We've got a couple more questions here, but just as a reminder, if you do want to ask a question, please type it into the Q&A box at the bottom of your screen. Question on ticket pricing here. Where does IAG see ticket pricing over the next year?
So we haven't commented on that, and we won't comment on that until our results in February. I think if you look at 2023, ticket prices have increased substantially from 2019, but 2019 was actually a pretty bad year for the airline industry. So I think the increase in ticket prices is somewhat overstated on that basis. I also think if you're worried about the sort of the price on an absolute basis, or think it's quite high, if you look back 10, 20 years, actually it's a significantly lower price. Travel has been democratized over the last 20 to 30 years, as the likes of Ryanair and EasyJet in particular will show you. So look, I mean, we will always try and maximize our ticket prices. We think we provide value for money, and there is still significantly strong demand and not enough supply in the market. So we are cautiously optimistic for next year.
Okay, thank you. We've got a final question here on the cost side, but as I said, if you do want to ask another question, please type it in. What proportion of costs are fuel, and what impact does a $1 per barrel drop in fuel have on profits?
Fuel is about 30% of our total costs. In terms of fuel and the impact on profit, it doesn't necessarily have a direct impact. Firstly, we hedge, so we tend to be about 70% hedged for the next 12 months at any one particular point in time. And secondly, the way that fuel tends to impact profits it is a sort of a second order effect and perhaps slightly counterintuitive. So when the fuel price goes up, it discourages inefficient capacity. So either existing airlines or new airlines don't add capacity that they know that will be unprofitable from the word go because of the high price of fuel, and therefore airlines tend to make higher profits in higher fuel price scenarios in general, and then vice versa. The price of fuel is too low, and you get a lot of people trying to come in and disrupt the market. So it's not actually an answer to the question, but I think broadly speaking, the fuel price we could do with it, frankly, being a little bit lower, but we are comfortable operating at this price.
Okay, thank you, Stuart. That now brings us to the end of today's webinar with International Airlines Group. I want just to say thank you very much for attending. And as you exit today's webinar, you will come to a short feedback survey, and it would be really appreciated if you could complete that. So thanks for attending, and we hope to see you soon.